Hey guys, thanks for tuning in today. I'm so thankful that you guys are watching this video. Definitely excited to tell you about something really cool today. So today, this video is going to tell you about 9 different ways to document your income to qualify for a mortgage loan. Yeah, there's 9 different ways to do this. So before I get started, do me a favor, subscribe, check out the comments below, look at my other videos. Would love to get you guys to subscribing. Drop me some comments. Let me know if you have any questions. Love to visit with you. That's what this is all about, guys. I'm a real person. Love to visit with you and talk about your mortgage needs. So without further ado, let's get started. So the first way to document your income is tax returns, right? That's the very vanilla way to get this done. Conventional FHA, USDA, VA, all require tax returns, right? So 2 years tax returns, 2 years W-2s, very straightforward. You're going to use whatever income you claim on your tax return. So if you're W-2'd, it's really straightforward. It's whatever's on your W-2. If you're self-employed, it's your after everything is written off income. So your net income, not your gross income when you're self-employed. The only thing we can count back on the self-employed side is depreciation. There's a couple of other things that we can manipulate as well, but generally depreciation is all you're going to get back if you're writing everything else off on your tax returns. So if you don't claim enough money on your tax returns, there's alternatives. Actually, there's 8 alternatives that you can look at besides tax returns. So I'm going to go down this list, and they're going to get more and more creative as time goes on. So the second way that you can document income is bank statement loan. So a bank statement loan does not require tax returns, W-2s, any of that at all. It just looks at either personal or business bank statements or a combination of the two. There's different solutions depending on what you want to do. So what happens is we take either 3, 6, 12, or 24 months bank statements, and the more bank statements you provide, the better your interest rates and terms. And then they look at your deposits. Now, if there's transfers between 2 accounts, they're going to exclude the transfers. But if you're depositing money, it's consistent. They're going to add that up over that period of time and then divide it by the number of months that you provided. And that's usually your income. Now, some lenders will require a CPA letter to state, hey, your expense ratio is this amount. So what that means is if you have $100,000 in deposits for the year and you have a 20% expense ratio, that means it's $80,000 in income. That's how that works. Some lenders will just take 50% of your deposits, and that's a 50% debt to income ratio. So it just depends on the individual lender. But the good news is you can use bank statements to qualify for a mortgage loan, which is cool. It's great for self-employed borrowers. Next set, asset depletion. Let's assume you have no income whatsoever, but you've got a lot of money either in the bank, stocks, some other very quickly liquidated source of money. The program looks at a 3-year average. So what this does is, let's just say you've got $1 million in the bank. It's going to divide that $1 million over 3 years, and that's your income. So $333,000 a year. Then you can qualify to purchase a home based on that asset being depleted over a 3-year period of time. Super easy product. Don't care about income. Don't care about employment in any way, form, or fashion. See, I'm tongue-tied right here. And so really super easy to qualify, very straightforward. We just have to prove the asset is there, divide it by 3 years, we're good. All right. Next one is 1099 only. So you're self-employed, you get paid 1099s, but you write off everything on your tax returns. Well, guess what? You can do the 1099 only product. All they do is look at your 1099s. They don't look at your tax returns in any way, form, or fashion. It's just your 1099s, and the same expense ratio applies. So you get a letter from your CPA stating, hey, we've got a 20% expense ratio on $100,000. Then your usable income is 80 grand, and then you qualify. So it's a really cool product. No tax returns required whatsoever, just 1099s. All right. Next, profit and loss only. So let's assume you don't get 1099s, but you do profit and loss statements every year. Then we can get audited profit and loss statements for 2 years and a year-to-date profit and loss statement that does not have to be audited with an expense ratio account from your CPA. Same situation. They're going to look at just your profit and loss statements, no W-2s, no tax returns, no nothing else, just profit and loss if you're self-employed. I hope you guys are getting the picture here. There's a lot of different ways to document income. Even if you're W-2, there's alternatives for income, but it's great if you're self-employed and you're trying to find a way to show your income without showing tax returns. Okay, Next one is called a no ratio loan. This is one of my favorite loans out there. So a no ratio loan means no income whatsoever. Let me say that again. No income whatsoever. As long as you have excellent credit and at least 25% down payment, there is no income whatsoever. It's that simple, truly. Excellent credit, you've got to prove your money that you've got for down payment. Then you can get a 75% loan to value loan and no income is required whatsoever. I keep saying no income is required whatsoever because I just wanted to make sure that you guys get that. No income. Great product. All right, the DSCR loan, the debt service coverage ratio loan. This is only for investment properties. So you're an investor, you want to start buying houses, whatever that looks like, but you have no income to show, then you can use the DSCR product, which means as long as the home rents for the new mortgage payment, then you can do up to 80% loan to value. So let me explain that a little differently. We're going to get an appraisal done on the house. The appraiser is going to do a rental analysis. So whatever he comes up with for the rent amount based on the subdivision that your house is in and based on the average rents for that property, then he's going to tell us, hey, the rent should be $1,800 a month for this house. So as long as your new mortgage payment on this loan doesn't exceed $1,800 a month, that's called a 1-to-1 debt service coverage ratio, then you can get up to 80% loan to value with no income required in any way, form, or fashion. You just have to prove your down payment. Awesome loan, great for investors. We don't care how many properties you own or how many you have financed. There's definitely some solutions there that you guys need to look at. It's a great product. All right, last loan program. I'm going to go a little outside the box, and that's called a reverse mortgage. Now, usually it's for 62 years old and older, but there was a lender that just came out with a new age at 55. I haven't done that one yet, but that's very interesting to know. So reverse mortgage is straightforward. It's designed for people who need additional income sources while they're in the house, or let's just say you want to buy a home using a reverse mortgage. You can do that. A lot of people don't realize that. So when you're buying a home using a reverse mortgage, let's say that you've got $500,000 in the bank, okay? And you're like, you know what? I really want to buy a house, but I really can't afford the mortgage payment, but I've got the cash in my account. I want to have a nice house where I don't have to worry about mortgage payments. All that's taken care of, and I'm 65 years old. Okay, that's a reverse mortgage. So in a reverse mortgage, you put down approximately 55%, and it depends on your age. Your age varies, and the older you are, then the less money you have to put down. The younger you are, the more you have to put down. But once you put that amount of money down, you've essentially doubled your buying power. So remember, I said you only have to put 55% down. So if I'm buying a $500,000 house, I'm putting it down just a little over $250,000. Once you buy the house, there's no mortgage payments for life. You still have to pay taxes and insurance, and you still have to maintain the property, but there's no more principal and interest payments on that property. It's done through a reverse mortgage. So it's another great way to get into a house with alternative income solutions. Guys, I've just given you 9 great ways to take care of a mortgage and not have to worry about tax returns or W-2s or pay stubs and everything else if you don't want to. So guys, reach out below, drop me some comments, ask me some questions. If you've got a specific scenario, I'm here to go over that with you. Let's talk. My number's flashing across the board right now. Call me anytime, and I really appreciate you guys. I hope you have a great night, and we'll talk soon. All right, bye.